If you've ever heard sell in May and go away, this year's market data is about to challenge that idea. Hello, I'm Eric Petway, Chief Investment Officer at Journey Advisory Group. Welcome to CIO Corner. Last week, markets were mixed. The S&P 500 rose 0.2%, while the NASDAQ 100 dipped 0.3%. Even so, markets remain near all-time highs, with the S&P 500 now up 8.7% for the year. International stocks pulled back last week, but continue to outperform U.S. equities year to date. On the macro side, the Strait of Hormuz remains closed amid a U.S. blockade, keeping oil prices elevated. Meanwhile, the U.S.-China summit concluded with limited new developments. One bright spot is earnings. S&P 500 companies are reporting Q1 growth of 27.7% year over year, well above expectations. If confirmed, that would be the fastest pace since late 2021, according to FactSet. Now for Chart of the Week. Let's come back to that idea, sell in May, go away. It's catchy, it's widely repeated, but the data tells a different story. Investors naturally look for patterns. It's how we're wired. But in markets, that instinct can be misleading. Historically, there was some evidence behind seasonal patterns like this, particularly before 2000. The 6 months leading into May often shows stronger returns, but since 2000, that trend has largely disappeared. Many of the months that were once considered weaker, including May, have actually delivered positive returns on average. In other words, the pattern hasn't held up. That's not unusual. Once a strategy becomes widely known, markets tend to adjust, or it may have simply been a coincidence tied to a different era. Take September, often labeled the worst month for stocks. Much of their reputation comes from a few major events, like the 2008 financial crisis and the 2022 bear market, not the calendar itself. There's no shortage of these theories for the January effect to the Super Bowl indicator, but they don't consistently explain market behavior. What does? Economic growth, corporate earnings, long-term investment discipline. Trying to time the market based on the calendar introduces a real risk. Missing just a few of the market's best days can significantly impact long-term results. That's why staying invested, saving consistently, and following a plan has historically been the more reliable path. We hope CIO Corner and the Chart of the Week provide useful perspective in uncertain times. If you find this helpful, follow Journey Advisory Group on LinkedIn or your preferred platform. And if you'd like to review your portfolio, reach out to your JAG team. As always, remain calm, stay focused, and most importantly, stay the course.